Johnson & Johnson just reported its second quarter 2026 results, and the headline number is $25.31 billion in quarterly revenue, up 6.6% year over year. Adjusted earnings per share came in at $2.90, up 4.7% from a year ago. The company immediately raised its full-year 2026 guidance, signaling that the back half of the year looks better than it did 6 months ago. The specific catalyst, 3 named oncology products, DARZALEX for multiple myeloma, CARVYKTI and CAR, AT&T therapy, and the RYBREVANT LAZCLUZE lung cancer combination, all grew faster than the segment average and together offset one of the most significant patent cliff headwinds in large-cap pharma right now. Johnson & Johnson disclosed these results in its 8K filing with the SEC yesterday. Before anchoring on the adjusted earnings figure, here is the GAAP picture. On a generally accepted accounting principles basis, diluted EPS came in at $2.27, down 0.9% from a year ago. The gap between GAAP and non-GAAP is standard for large pharmaceutical companies. Amortization of acquired intangible assets and one-time charges compress the reported number. The adjusted figure strips those out to reflect underlying operational performance. What is harder to argue with is cash generation. Johnson & Johnson produced $8.7 billion in free cash flow during the quarter alone. That is the cash the business actually throws off after capital expenditure, and it supports the dividend, buyback programs, and continued pipeline investment simultaneously. The innovative medicine segment, Johnson & Johnson's pharmaceutical and immunology business, posted $16.38 billion in Q2 revenue, up 7.8% year over year. That segment represents roughly 65% of total company revenue, so its trajectory sets the tone for the entire report. Operational growth, which strips out foreign exchange movements, was 6.8%, meaning currency translation added about 1 percentage point to the reported rate. The growth drivers were concentrated in oncology, the DARZALEX franchise targeting multiple myeloma, CARVYKTI for relapsed and refractory multiple myeloma, a CAR, AT, and T-cell therapy, and the RYBREVANT and LAZCLUZE combination for non-small cell lung cancer. All 3 grew above the segment's overall rate. Here is the friction point embedded in that 7.8% growth number. STELARA, once Johnson & Johnson's largest immunology product used to treat Crohn's disease and psoriasis, has been losing market share to biosimilar competitors as its patents expired. That erosion created approximately 760 basis points of drag on the innovative medicine segment's revenue in Q2. 760 basis points is a 7.6 percentage point headwind, absorbed inside a segment that still grew 7.8%. The oncology portfolio is, in effect, replacing lost STELARA revenue entirely and generating net segment growth on top of it. Whether that math holds through Q3 and Q4 depends on how quickly biosimilar penetration accelerates from here. The MedTech segment, medical devices and surgical tools, contributed $8.93 billion in Q2 revenue, up 4.5% year over year. Operational growth, stripping out currency effects, was 3.6%. The gains were concentrated in 2 areas: surgery, where wound closure and biosurgery products drove the line, and cardiovascular, where electrophysiology devices and the Shockwave intravascular lithotripsy platform posted growth. MedTech is partly tied to elective procedure volumes, which makes it more sensitive to economic cycles than the pharmaceutical side. The segment delivered mid-single-digit growth, holding its recent trajectory and contributing meaningfully to the company-wide beat. The piece that matters most for how investors interpret this quarter is the full-year guidance revision. Johnson & Johnson raised its 2026 revenue midpoint to $101.1 billion, representing 7.3% growth year over year. Adjusted earnings per share guidance was lifted to $11.68, implying 8.2% year-over-year growth. A guidance raise issued in the middle of the year, after a company has already absorbed known headwinds and reported 2 full quarters, is a more credible signal than a January forecast made before any of the year's data came in. Management is effectively telling the analyst community that the oncology franchise and MedTech pipeline are running ahead of internal projections and that H2 execution is tracking. For macro context, the 10-year Treasury yield sat at 4.62% as of July 13th, and the federal funds rate stands at 3.63%. A still elevated but gradually easing rate environment. That backdrop matters for a dividend-paying, large-cap healthcare company. Higher rates pressure the relative valuation of stable, income-generating equities, and any easing provides a modest tailwind. Separately, Jefferies flagged Johnson & Johnson's Spravato, its nasal spray esketamine treatment for treatment-resistant depression, as a growing revenue contributor with implications for the broader psychedelic drug therapy market. Spravato was not the headline driver this quarter, but it represents a pipeline leg that the street is beginning to model more explicitly for the back half of 2026 and beyond. The core takeaway from this quarter: Johnson & Johnson absorbed a 760 basis point biosimilar headwind on STELARA, grew total company revenue 6.6% anyway, and raised the bar for the full year to $101.1 billion. Free cash flow of $8.7 billion in a single quarter gives management the financial flexibility to keep funding the oncology pipeline while returning capital to shareholders. The execution question for the back half of 2026 is whether the DARZALEX and CARVYKTI franchises can sustain their current growth rates as they scale, and whether STELARA erosion accelerates beyond what is already baked into that revised guidance. The Q3 print will be the first real test of whether this mid-year raise was conservative or aspirational.